Welcome to our High Rock monthly video for February. I am Scott Tomlinson, and with me on the call today is portfolio manager Paul Tepsich, who founded High Rock back in 2010. If you are interested in learning more about us, visit our website at www.highrockcapital.ca. All right, well, let's quickly talk about January. January was a very foggy month in Toronto. I think, Paul, it was the lowest amount of sunshine hours on record, if I got my weather right in Toronto.
Well, December might have been second lowest.
But the sun is shining and has been for the last few days, which is lovely. And let's talk a little bit about markets in January. The sun was definitely shining on the Canadian preferred share market. Paul, I will let you talk about that in a second. But generally, other markets were slightly better in the world of equities, slightly weaker in the world of bonds, REITs, gold and silver, and all-in balanced portfolios were up, but marginally so. And Paul, over to you to talk about preferred shares and maybe just how that's going. And of course, we have our new preferred share mandate. You might want to talk a bit about that too.
Sure. Yeah, and the special mandate side of our business, we back in first, second week in November for most investors, we started a new mandate buying rate reset preferreds. Our timing was quite good. Could have been a snick better if we had more clients in early October, which kind of was the bottom in that sector of the preferred share market. But it has done very well. As you can see in that previous chart, it was up over 6% in general for that sector. So been good. I think the preferred share market is just getting back to getting closer to fair value, kind of mean reversion, if you will. But there are still some really good pockets of value in there. So we're going to stick with our program moving forward. Also within special mandate, we have the high yield mandate, which is kind of clipping along. Again, there's a couple pockets of value, but that market is done, as we've said on this call many times, it's done exceedingly well over the past 3+ years. So I'm not surprised to see a little bit of slowdown in performance, where we will see more of a coupon or interest income earning year. I wouldn't expect enormous capital gains in most of our positions.
All right, thanks for that. And always, as a reminder, our focus is on your specific long-term goals and how we meet those goals. So it's always important to review your strategy, and this is a great time of year to do so. I've had lots of conversations with clients reviewing strategies through the month of January, and that will continue through February. And of course, it's also RRSP season and tax time, so there's lots of reasons to talk, and I invite you all to get in touch if you feel like you should. Very quickly, the global equity strategy, as we've talked about in the past, we find equity markets to be somewhat expensive. One of the metrics that we look at that defines expensive is something called breadth, when the broader market is underperforming or being driven, I should say, by a very few number of stocks. Paul, in the past, it was 10 to 12 stocks. Now it's really only 4 that are driving the S&P 500. And we can also look and see the broader market. The Russell 2000 is actually in negative territory to begin this year. So that diversion from these few that are performing well, but the bulk not so, is what we call market breadth. And when it widens like this, it's tends to be a negative signal for stock markets.
Yeah, that certainly is one problem with the overall market for sure, being driven by these, so-called Magnificent Seven. We've gone from the FANG stocks to these Magnificent Seven, mostly with the addition of NVIDIA, as you can see above.
I think we lost Paul there for a second, so I will just continue on briefly, hoping he will be back.
Can you hear me, Scott?
We got you now.
Yep, sorry about that. I was just saying that we used to call them the FANG stocks. Now we added in largely NVIDIA, and we have the Magnificent Seven. But either way, whether it's 5 stocks or 4 or 7 stocks, it's out of 500 in the S&P. It's kind of, as you said, very poor breadth, and that has been a negative in the past. Certainly something to watch for and be aware of.
Anything to update us on the tactical model?
Yeah, there was no real positions added or subtracted from. One that we don't often talk about, but has been really improving in the background over a couple year period is a distressed bond that we bought a number of years ago, called Source Energy, which is a sand fracking. They actually mine sand in Wisconsin and deliver it up through Lake Ontario, and then train it out to the Western Canadian Sedimentary Basin, and it's used to go down pipes and into fracking. It breaks up shale and releases gas and oil. That company, obviously these bonds, as I said, were distressed, and they restructured some of their debt a number of years ago. We ended up buying these bonds extremely cheaply, and in price terms, they are very well bid now, getting close to par at 95 cents on the dollar, and we ended up buying them at an average price of probably this is in our balanced mandates as well as our high yield mandates. That's their biggest weight in the high yield mandate, but it's one of our biggest weights in the tactical mandate as well, or the tactical model within our balanced mandates. But if you look at the yield that we've picked up on an annual basis, it's stunning. So it's doubled in price from our average cost base. But if you add in the interest income that we've made on that bond, it's probably more triple plus. So it's been a great risk-adjusted return trade for us. So I think that bond will get refinanced with some private credit, because it's only got about a year left to maturity. That's the one highlight in the tactical model to talk about, Scott. There was really, as I said, no additions, subtractions.
Okay, great. Thank you. That's a nice success story. Fixed income?
The only real addition to, in fixed income, other than for some newer clients that we were getting invested up, we did add, a preferred share in there. We talked about preferred shares earlier in this call. We did add one in the preferred share sector within fixed income, and that was the TD Bank. B as in Bob. That has done pretty well. And again, we think that a preferred share is going to be taken out in the at $25 in July. We should hear by June, 30 days in advance of the redemption date. But it continues to do pretty well, and again provides us with pretty good dividend income in the meantime. So that was really the only addition. Fixed interest rates in general, we ended the year, say, with 10-year Canada's darn close to 3%, 3.10, and at the end of January, we were up towards the 340 area. So we kind of gave up about 30 odd basis points over the course of the month of January. So that weighs slightly on our overall fixed income portfolio, government bonds and investment grade bonds, but still extremely volatile, as you well know.
Absolutely. Okay, thanks for that. Moving on to 2024 more wealth management circumstances. We mentioned this last month in our call, but TFSA contribution room this year is $7,000. I've been chatting with many clients who've given us instructions to go ahead, but we do need to talk to more. And if you have not yet given instructions, please do so. Also, it is RSP contribution time, and there is the new FHSA. If those of our clients have any interest in that, please make sure to get in touch. As I mentioned, it's RSP contribution time. You have until February 29th this year to make your 2023 contributions. So if you've been talking to your tax specialist and they recommend putting money in your RSP, then let us know and we will make sure that that gets done. Or you can do it directly by doing a bill payment to your RSP through Raymond James. As well as if you are on the fence as to whether or not you should be contributing, again, it's a call that we're happy to engage in and have those discussions. Also, what's important is it is tax time. So your 2023 tax receipts will be coming. There are the dates. As always, we want you to make sure that you do not submit your tax return before you receive all of your receipts. And you'll notice that some of those receipts come not until early April, so be wary of that, and also take that into consideration in your when you're filing your taxes. Other reports, as you can see there, the fee summary is also something that is important, and that comes at the end of this month. If you have any questions or anything to discuss, I'm available. Diane's available. We want to have conversations. We want to assist you as best as we can to get your tax preparation done as quickly as we possibly can. So you let us know how we can help, and we shall do so. All right, that's our contact info if you need a refresher, but always we want to thank you for taking the time out of your busy schedules to tune in. We'll be back with our next update at the beginning of March. So on behalf of my colleagues, Paul and Diane, wishing you the best of February, and take care.